Good day, everybody. Today is July 22nd. Today is going to be kind of a long video. Just so everybody knows, I got my market data feed working. If you follow me on my quantlabs.net/blog. In this video, I'm going to go over the benefits of categorizing all the different ETFs I have access to on Interactive Brokers, which is over 934. And I'm just going to show you the benefits of how I'm doing this. So first of all, let's just take a look at where we're at today. Again, 22nd of July. So again, 4 Eastern Standard Time, 4 o'clock. And check out where everything's at. All negative. Crude is down. Gold is up slightly. We had crypto for a while rallying. That looked like it may go places, but it goes back to its old ways, being negative 2.5% on Bitcoin. Forex is just up and down. It's not good. Okay, so we're not going to make money chasing after potential returns. So let me introduce you to all of the different categories and tear sheets that I'm able to generate by accessing ETFs by categories. For each category I look at, and being able to filter out all the negative ones and only focus on the profitable ETFs for that category and give you a comparison against other segments in the economy. We'll leave it at that. Okay, so this is the first one. So what we're looking at here is we've got this one is metal. So this is going to include gold and silver, industrial metals, and whatnot. Generally what I'm finding is, depending upon the number of ETFs for that particular category, a lot of them, these ETFs are negative. Okay, so if you have a portfolio manager choosing those type of ETFs, you're not going to get a return whatsoever. But there are going to be, as you'll see, certain ETFs that perform. Okay, but just because it's performing in that category doesn't mean it's the best. Okay, so let's take a look at the first one. This is the metals. This is gold. So this is typical what you'll see with metal. It's been very volatile. Here's our Sharpe ratio, and that's when I'm using the measurement by comparing each one to each other. So this one is 1 Sharpe ratio. Okay, so when you look at the volatility, it's pretty severe. Even if you smooth it out logarithmically, it's a little better, but it's not stable. Okay, now the first thing we want to obviously look at are our monthly returns. June, huge loss, big time. So this is the sort of thing you got to be on the lookout for. And again, this is year over year. Okay, so that loss right there, net wise, I don't know. You're not making a lot here. You would have done well, but then it's just really volatile. Look at that big drop here, and it might come back. That's why you always look at the current month. So we're up 10% for metals. Okay, and that's out of the performing ETFs. Okay, so that's what you really got to watch out for. But I'm going to be doing a complete, what I call a master trading script or programming script that will compare everything and choose the best of the best out of that lot. Now here's the next one. This one is energy. This is probably out of the categories I could find, this is probably your best performing. But something happened in June. It was just such an ugly month. You got such a big drop off here. But we're now starting to potentially get another big run up, as with between here of January till about June. But just June was such a bad month. So we might be starting to get into another run up. So again, you always compare against the S&P 500 in yellow. Now, out of all of the available ETFs to select for, energy, it's oil, natural gas, infrastructure, transportation, like pipes, all that kind of stuff. On top of that, there is some clean ETFs in there, like clean energy. Those were all negative. Okay, so only the mature I don't know, dirty oil, I want to call it, were profitable for over the last year. Okay, the clean energy is just not profitable. Specifically, one called Windy just didn't do all that great. So here, again, we start to again look at the monthly returns here. Look at January. That's in the heating month there, but here you can see we've got really a down month here, negative 77. But it just came roaring back here for July. Majority of the ETFs out of this lot were profitable. But there are a few negative. What I'm finding is if you want to be able to get maximum profit, in this case there's so many, all I did was I just took the top 15 performers and kept those. They were the usual USO, oil, among all the other big ones you may know of, UNG. So this was pretty strong. Okay, for energy, so that's a pretty good one overall, despite the negative whipsaws here. Okay, so that you can see the outperformance already, starting for July. It's quite different, I guess you could say, but you do have one bad drawdown month and day. So overall, something, you know, this is what you got to be concerned with, but net you're doing okay. But I do think the way it's looking, we may be in another big upswing for at least metals. Okay, so continuing along here, now we are looking at Treasury. Okay, this is just pure government debt. So imagine you're paying money tax-wise into the U.S. government, and this is probably could be said right across the board, across all Western governments. It's basically a money pit. You're being taxed, and they're like at the Treasury end. No one wants to buy them, and you can just see how. Now again, I had 24 Treasury-related ETFs to choose from. Only 2 were profitable. You can see what they eked out. The Sharpe ratio is not bad comparative to other, let's say, energy. So here you got 1.55. I think it's because of the volatility is not there. But again, that's only 2 out of 24. So right there, knowing which are the 24, which are the 2 profitable ETFs that perform profitably over the 24. So just learning this alone makes a huge difference. Out of those 24, so let's say 2 are profitable, 24. So 2022 were bad. So that just goes to show how bad these ETF operators are just not doing their job properly. So you got to know which ETF providers and which ETFs are profitable here. But you can see here, 1.46 is not bad. You just got to make sure you pick the right ETFs for that. But anyways, so that's pretty good. You can see a really, not a great performance, but that Sharpe is not bad. Okay, for stability. Okay, but you're not getting a lot of return. So let's go over to here. Now, if you're looking for slow and steady, these are for people that are in retirement. I wouldn't even recommend it because you got 1 negative month. But if you want to eke out a little profit, go into Treasuries, and you can see here. And again, that's out of 2 out of 24 profitable ETFs. So not the best place to go, but there's no volatility here. Next up, we have here income. This is now again for, let's say, comparative people going into retirement. These are not bad. Okay, so again, this is how abysmal the performance is with ETFs. Let's say there's 25 ETFs. I don't know the exact number. It's 24 or 26. Only 2 are profitable. So only the top 10% were profitable. Now, if you were to be in out of those 24, 90% of those ETFs that were negative, you're not going to have a really good return. So this is why it's very, very important to know which ETFs are doing well. Out of this lot, I'm going to be giving you a gift in your retirement. The Morningstar Leader, I think it's called Morningstar Division Leader. Okay, so Morningstar Dividend Leader. Okay, so there's a ton of corporations in that ETF, and a good chunk out of the 2 were to be allocated to the Morningstar one. So you can see here, it did pretty good. 2.23, it's fairly strong. And now I'm hoping you see the benefit of categorizing these. And at the same time, when you have a category for, let's say, dividend income, that you focus only on those two ETFs, and yet you still the max drawdown is within that 15% tolerance. So this one right here is a decent one, and it's just killing the S&P 500 too. Okay, so 2.23, but it reduces a lot of that negative impact of volatility. So that one's not bad. Let's take a look at the monthly returns here. So again, very small dip comparative to the energy, which was like negative 50 or negative, but the monthly returns were pretty good. 25% for April, 20% for June, and then July. So again, when you're banging out throughout the month, day by day, you could, the current month, you could see that maybe you're not going to get quite the performance this month till you switch all your capital to better performing ETFs for the month. So let me just see here as an example. So with this one, you can see, yeah, it's not so strong. Yeah, so as an example, okay, so we know our July performance just sucks, 0.42%. So why don't you just take that capital out and move it into here, into energy, okay? So you can rebalance all those ETFs and move the majority of your money as July progresses, and you'll get better performance here and not have your money tied up. Yeah, you will pay commissions to get out, but on the other hand, when you factor moving into energy for the month of July, you will get a way better performance. So I'll easily negate all the commissions you pay out for that transfer from dividend income back into energy for the month, because you know July is a better month for energy. Because each month you run these, you'll start to see that yes, the performance is better in energy. Just as an example of why the categorization of these ETFs is so important. And again, only focusing on those ETFs that perform. Okay, I'm doing this every day and knowing which ETFs perform, which ones don't, and just ignore the ones that are going to give you a negative return, because my portfolio optimizer will forward guide based around that. So right there, you would save a lot of money and get better returns for July, knowing if you move from dividend income into energy, as an example, because you're going to get way better performance for energy with a 70 plus return in energy. Now again, a lot of these ETFs are mainstream. These are not wonky ETFs. They are the better suppliers I'm seeing or providers are like Pro Shares. There's some boutique ones, but I will tell you, I'm not seeing any so far. Well, I shouldn't say yet, but not the Vanguards, not the BlackRocks or the iShares or whatnot. Okay, so I just want to highlight that as well. So that's dividend income. So let's move over to the next one. Now this is where it gets interesting with crypto. Okay, without crypto, the hype, I post a lot of news on crypto. A lot of it is just when you factor in your portfolio, this is what you get overall. Now there's not very many ETFs or trusts from Grayscale for crypto. There's about 4 with crypto overall since the beginning of the year. Now this again, you can see when this started in September. A lot of the crypto related are negative. This includes crypto miners as well. So everything's negative. But there's only one that was profitable out of this one, which was the Grayscale Ethereum Classic, and it doesn't outperform the S&P. So the question becomes, why would you put money into crypto when you're just not getting any form of return? This is the absolute worst, category. Okay, you can see that crypto easily is way worse than the S&P 500. And right here you can see it. For July it's better for this particular one, but generally everything's all negative except with March as well. So, and that's just again for only Ethereum Classic. So we can gauge which is one of the better crypto ones to go into. And again, I can then take the best performers of all the ones I'm showing you and put together a master portfolio or trading basket or index, you want to call it, and then be able to allocate which ones are really good for that particular month or for that particular week or whatever. So you can see the power of this. Now, this doesn't stop. I'm just showing you the most talked about sectors, categories, and there's, as I said, there's metals, which will include gold. There will be, and again, those are one of the top performers out of those ETFs for metal. Among those ETFs, only profitable ones, energy, which is oil mostly, and natural gas. We also included here as a comparison dividend income. I've already highlighted which one is good, and crypto as well. So this is a pretty good blend, but right now dividend income comparatively appears to have the best performance. Let me just make sure of that. So here for dividend income is 2.23, so that's pretty good. Anything over 2 is good. Tear sheet for the crypto, you can see here sharp negative 0.49, not very good. Let's check out the Treasury. This one's not bad. 1.46, but you're not getting any performance at all, so ask yourself if you really want to deploy capital at that. And the last one here is energy. That one's completely very volatile, but you see here sharp 1.55, and then metal 1. So which was the best performer? A lot dividend income. So I can also like slice and dice the U.S. equities, U.S. categories. It just goes, there's over 40 I categorize for just anything U.S. related. Those ETFs, we've got overseas, so I can get China, Europe only, Latin America. We also can do by, well, I can just do this. Let me just load up this one right here. So here, what you can categorize on. We can go financial, and there could be bear, bull, with leverage and without leverage. As I talked about overseas, I've already done the real estate one. That's doing okay since May. Treasury, we've got U.S. category is the big one, obviously, and I can build watch lists now. I've just put up a video on that. So we're very, very, really good here. On top of the other currencies of emerging debt currencies that are just blowing up in returns as well. I've highlighted those over the last number of months. So those are all specific to Interactive Brokers. They're not using or tradable on Interactive Brokers if you're in the U.S. Okay, so there's no more Oanda. We've got a really good supplier now for data. I've already shown what I can do in MotoWave, and you already know what MotoWave can do. So this is a really, really, really exciting time now to be part of this. So if you want to get in, this is where it's at. Get in on, get your portfolio assessed and evaluated. Fill out your name, email, info will not be shared. Sign up and send me your equivalent symbols in Interactive Brokers. All right, and on top of that, right now we've got the what I call the Quant Analytics. If you go to Quant Labs Academy and then buy Quant Analytics, it's very cheap. So all is going to be included in this with this type of analysis, and you can definitely tell how powerful this will be right here at 47 a month. This is going to skyrocket. I've looked at what's called MarketSmith, $125 a month just for the basics. That's just to give you access to the research. On top of this, I'll be now live trading probably the next week. So once I start to actually deploy capital with these trading ideas, and then on top of within a few weeks to months, I'll have hopefully a track record, verifiable track record against Interactive Brokers, and then the price is just going to go up beyond that. So as I said with MarketSmith, it's 125 a month. So if I go beyond that, that's the value just for the research alone, let alone the trading and the verified trading as well. So you can see how valuable this will be. Now, from my perspective, this sort of service is really geared towards hedge funds, banks, family offices, that sort of thing. And they will pay probably thousands of dollars per month. It's been verified on top of the research as well. Okay, so that's where we're going with this. This is something, as I said, I'll be able to build out a huge reports, charts, all of this tear sheet stuff, and that's what the industry looks for these type of stats. Okay, so for retail, get in at that price right away, because this is very, very valuable, especially when you have the trading on top of where that trading performance is verified. So yeah, it's early days right now for what's being built up. I'm just giving you some examples of when you can rebalance from, as I said, from dividend income to energy. You get better return for that month. Okay, we'll leave it at that. Thanks for watching, and get in on this right away, because this, I don't see why I should be holding it back at that price. All right, thanks for watching. Have a good day.